Good morning and good afternoon for those people that are outside of the US. Welcome to Showcase Broadcast Studio, and thank you for joining us. My name is Michael Wardy. I'm a certified financial planner and the Senior Strategic Director here at Source Advisors, and I'm very honored to introduce Jim Foster and Brian Coddington to today's conversation on the 174 amortization issues and everything behind that. We have a lot to go through today and probably a fairly short period of time. But just as an introduction, I want to introduce first Brian Coddington, who is Source Advisors Director of Tax Accounting Methods and Credits. He provides compliance, consultation, and audit representation services in the areas of tax accounting methods and credits. Brian has represented taxpayers before the IRS in matters of LIFO, UNICAP, cost seg, and R&D claims. And he has represented clients before the IRS's national office in numerous accounting method changes. Thanks for joining, Brian. I also want to introduce Jim Foster, who joined us in 2022 and has specialized in tax incentives, such as R&D, disaster relief credits, and more recently, the ERC. Jim has been practicing in the area of taxation and tax law for about 15 years and has been a leading producer of successful tax credit cases for his corporate clients. Jim, welcome also. Thank you for joining. All right, gentlemen. We have a lot to go through. And for those out there on LinkedIn, YouTube, and Twitter, if you have questions, there's an area for you to post those questions. We will try to get to those questions. We have a lot of information to present about amortization of 174. This is something that, as the guys will talk about, came out in 2017 with the TCJA Act. Nobody really thought about it. Everyone started thinking it'll go away, it'll be repealed. It hasn't. In 2022, it is here for tax years in 2022. We've had deep conversations with CPAs, tax professionals, tax attorneys, clients about this, what this means to them. The reason that I wanted Jim and Brian to join today is because the amount of questions that are coming in and the uncertainty and everything. I have a list of questions that I've already gotten this morning from people that said, hey, I can't join. Can you just please throw this out? There's going to be more coming in. Gentlemen, let's get started. Can you just give an overview of this whole amortization of 174?
Sure. Essentially, what ended up happening is with the Tax Cuts and Jobs Act, they had to include a revenue raiser to help pay for it. And what they did is they put in an amortization of R&E expenditures that would go into effect 5 years later with the 2022 tax year. And that was supposed to raise $110 billion over a period of 10 years. What was the thought process was they would put that in and then they would either fix it before they were out of office, or it would become the next presidency's issue and congressional issue, and then they could fix it. There was a lot of legislation that was including the 174 fix, such as the Build Back Better Act and other items that was going back and forth, and everybody thought it was going to be fixed, and ultimately it wasn't. It was ultimately tied to, the Democrats were tying it to the child tax credit, whereas the Republicans were saying, why should we cave on something that you want to get fixed also? And so nothing got done on this. Now we're left with this being the law of the land, and R&E expenditures now need to be amortized over 5 years. This is detrimental to anybody who is having R&E expenditures. And I'm going to share my screen here real quick. And I'm going to share some of the common industries that are being impacted by 174. And as you can see here, software development, financial services, and video game developers all fall within the software development category. And all software development costs are now 174 costs. So essentially, anything that's dealing with software development, you need to include. But 174 is much broader than that. And we've listed out several industries here that are being affected by it. And you can see it even includes like cosmetics and agriculture, food and beverage industries, plastics, oil and gas, electronics. Essentially, anybody who is developing a new or improved product or process needs to be evaluating 174. Excuse me. And this is something that is very, very broad. And what ends up happening with the numbers is you amortize 10% of your cost in the first year, and then 2020 over the next 4 years, and then 10% in year 6. That means that in year 1, 90% of your R&E expenditures need to be included in income as compared to being deducted. This is extremely detrimental. Potential 174 costs are going to include all of your Section 41 research credit costs, your direct expenses such as salaries and wages, computer rental or lease costs, a haircut on the contractor costs, and your supply costs. 174, though, is broader. It includes all those costs, but it also includes the gross wages and other payroll costs, overhead, office supplies, occupancy costs. Essentially, there was a lot of case law in the 50s to 70s that made 174 very broad because it helped taxpayers with their deductions. Now that's coming back to bite us because it's so broad that we have to include all these items. Please note that you do not get the 35% reduction on contractor costs underneath 174. You have to take 100% of them. For salaries and wages, you have to take the gross wages, not the taxable wages, things like that. Michael, do you want me to go through the example on the 280C or hold off on that for now?
Well, I just had a question pop up that I want to throw out to you guys. And this came from someone from earlier this morning that said that they couldn't attend. How do we identify all the costs incident to the development or improvement of a product? And I guess we could throw in process as well.
That's actually really good.
Let me add one thing. If you're not tracking it, what do you do?
That's a really good question because at best, taxpayers have been tracking Section 41 costs. That's what we've historically seen. And even then, a lot of taxpayers aren't tracking those very well. 174, because it's so much broader, is a facts and circumstances driven analysis. And what you do is you have to go through the general ledger account and your 41 study. Your 41 study is a good place to start saying, here, we know these are 174 costs. Then you can go through the general ledgers and say, okay, what beyond 41 do we have in these other accounts that we need to include that are incident to the development of a product or process?
Mm-hmm.
Yeah, that's a great answer. And I'd like to add a little.
Please.
I mean, think about a non-traditional research company. Because this affects software development, everyone develops software in this day and age, it seems like. So what are we really talking about? Well, imagine something like an auto dealership. You know, you see them all over the highway. You know, they're everywhere in America. But, you know, they do have software development. So where do you start out? I mean, you start out with the GL accounts, yeah. You look at maybe the organizational charts for the employees at the dealership, and you start identifying, you know, based on your understanding of 174, where activities could actually be happening. Now, at an auto dealership, they're probably not doing much in the sense of classical research.
Mm-hmm.
But in terms of software development, well, what are you going to look at? Obviously, you look at where's the IT department? Where do those costs get captured? how does it get captured? Who is it? Is it a contractor? Is it an internal department? Have there been any major software implementations like a new dealer management system? Which, if you don't know what that is, think about the auto dealer version of an enterprise resource planning or ERP system. Just this big software that runs everything. Has that been implemented in 2022? Because the key point is we're only looking at tax years beginning after 12/31 of 2021. We're not looking back into the past. We're only looking at current 2022 activities. So that does help a little because you're only looking at 2022 and you're asking questions. Okay, this IT department, did they do any software development?
Mhm.
Who are these people in it? Yeah, and dealership's easy to think about because most of them are relatively small organizations. And so you say, okay, there's 5 people here. What were their roles? What did they do? How did we capture those costs? And the answer would be, well, it's in a departmental cost center. And that's if you're lucky. I mean, a lot of places don't even have those. So
Right.
at the end of the day, it's identifying what they have and finding ways to allocate costs. In some
Right.
cases, it's going to be easy. Yeah.
I apologize for interrupting. Go ahead.
Oh, no. Oh, no, you go. What was the question?
A question just popped up. You had mentioned about tax years starting after 12/31/2021. Someone just asked, my tax year doesn't end until September 30th.
Means their first tax year they'll be affected by this is the year beginning October 1st, 2022. And so 9/30/23 is when that tax year ends. So they actually have way more time than everyone else to plan for
Yeah.
this. It's a really great thing for them. The only time we really run into trouble with those fiscal years is if someone ends up having a short tax year, in which case, I mean, worst case scenario, I mean, they had a short year that ended in January of 2022 and the return's long since due.
Yeah. So what happens, and this question didn't pop up here, but it happened, a client of mine asked earlier, what happens if they sold their business in the middle of the year? Let's say they sold in June, whenever it is in 2022, they finished the year.
That's always a tough one because first question is, well, how did they sell their business? If it's a stock sale, they're selling the ownership interest in the building, the business itself, and
Mhm.
it's treated as that for tax purposes. Well, nothing happens. It's just a normal sale of a business. Though there is a wrinkle there.
Why would it be easy?
Well, of course, if they sold it in an asset sale or something that is treated as an asset sale for tax purposes, the statute itself, which is all we have to work with right now for 174, is fairly unambiguous. You continue to amortize your 174 costs even if they've been disposed of. And dispositions, pretty much anywhere in the Internal Revenue Code are going to include sales. So it looks like when you sell that business, you keep amortizing those costs, which that's an area where we would love Treasury to provide guidance, hopefully saying, well, you don't have to, you can write it off under 165 as a loss or something. But
now that's for an asset sale, right, Brian?
that's for an asset sale. Now, I did mention there's a wrinkle on stock sales. So you had 174 expenses.
Mm-hmm.
They don't hit the balance sheet. As soon as you capitalize and amortize them, what if that pushes you above the asset threshold for, say, a Section 1202 stock sale, small business stock sale,
Mm-hmm.
where you get these really nice tax benefits? Well, in that case, 174 can be disastrous because if you've been planning on selling a company and making use of those provisions, all the tax planning is thrown out the window because now you have to capitalize and amortize 174 costs. So even on stock sales, there can be problems. But that's mostly for smaller taxpayers.
So wait a minute. I want to go back to what you said earlier. You mentioned that, you still, if you do the sale, I think it was on an asset sale, you still have to amortize. Maybe this is a dumb question. The acquirer has to still amortize those costs.
Well, the acquirer would treat them, would figure out how those costs are treated. Could be a 197 intangible, could be something else.
So hold on.
It's definitely a situation where both parties could end up amortizing the same essentially costs. Or
What
at
am I
least the same
amortizing if I
project.
sold my business? I don't have anything. I walked away. I retired.
You get a
There
loan.
are other provisions where this can happen. Most commonly, we see something such as wrapping up costs, perhaps the cost of litigation years down the road for a business that was sold or shut down. These things do end up on tax returns, and there are ways to report them.
Okay, that's beyond me, but I'm glad you guys are here to answer those questions. Jim, I don't know if you want to share your screen again and go through. I think you had an example that was actually interesting, and it ties into a couple of other questions. But while you're doing that, this question popped up from one of our viewers right now, and it's also one of the questions that popped up this morning. Actually, this one came in last night. Any chance that Congress will change this soon?
Yeah. Well,
great.
There is a chance. Cue the Jim Carrey meme from Dumb and Dumber. You're telling me there's a chance. Yeah, there is a chance. And the reason there's a chance is both parties want to do something about this. This provision has a real impact on real companies, real businesses. If you've been following the press, the Wall Street Journal or somewhere else, you might see reports that certain companies have said, oh yeah, my taxes are now $1 billion some dollars, $1.5 billion higher in 2022 just because of this change in the law. And talking to small businesses, there's very frequently a situation that we run into with, sadly, increasing frequency, and it is, so we're talking to a small business, and as soon as they come to the realization this affects them, they say, well, this isn't going to work. I'm going to have to go to the bank and try to negotiate a loan. I can't pay these taxes. I may have to go into the IRS for an installment agreement. So if this doesn't get fixed for small businesses, installment agreements are, theoretically a one-time thing. You aren't supposed to go in and get them every year, but this fundamentally changes the nature of income taxes for research intensive and software intensive small businesses. And, we've heard that for, say, the SBIR program, it could almost wipe out that government program, just through the unintended consequences of having to capitalize and amortize their costs. So
I'm sure that was an unintended consequence, but
so to circle back to Congress trying to fix this, the issue is there is will to fix it, but there's also the idea this is a business tax extender now. It's a benefit for businesses. That has been tied up in the Senate with the child tax credit, so it's an issue of working out a deal on that, and then finding must-pass legislation that you can attach a tax title to, which are really only about 5 options for that this year, 2 of which aren't going to come around again until around December. So, there's a chance, but there's also a chance, it could be too late for some taxpayers for 2022. That, they may fix it after, say, 9/15 or 10/15.
And we won't project into hypotheticals that if they do fix it, will it be retroactive? Will it just be, hey, it affected 2022 going forward? It's not going to. We can go down a whole nother path.
Right, and there are a lot of ways they could fix it because this is implemented on a tax accounting method change basis for 2022. They could say, well, it is retroactive, but you can't amend 22. You have to file a method change in 23. which would just, shift it from one year to the other. And so taxpayers would still be on the hook for 22. A lot of options for what could be done.
All right. Well, it's not, I'm sure it's encouraging. I know that there's encouraging. It just creates a lot of angst for me and having these conversations and realizing what the impact is for these businesses. But Jim, this is an example that I'm glad that you're sharing with us and with the viewers, because it really brings everything into light. We have a lot of companies that are like, what does this all mean to me? I've been claiming the credit for a number of years. We'll get into, should I stop claiming the credit? What if I just tell everyone, hey, I don't have R&D? Is that a good argument? We can go down that path as well, but let's go through this example and then we'll get into the other questions that are coming up specifically about that.
Sure. So in this example, I've got a lot of information. So let's walk through it piece by piece. What we're doing is we're looking at year one of the amortization table here and what's going on in relation to the R&D credit and tax liabilities and things like that. So if we assume that the taxable income before amortization is 1.5 million, that's going to give us tax liability of 555,000, assuming a 37% tax rate. Mm-hmm. If we assume that the company had $1 million in expenses, R&D expenses, which is real easy to hit, the amortization would be 100,000, and you would have to add back to income $900,000 because you're only getting to amortize the 10%. The other 90% is being carried forward into future years. This means that our tax liability, our revised tax liability, is $888,000, which is an increase in tax liability from 174 of $333,000. So year one is the hardest hit for taxpayers, and it's a big deal. Now, if we assume that the gross credit is $140,000, that makes the net credit $110,600. Okay. With the revised 280C rules, which is the rules that govern when you have to add back the gross credit to income or not, what it says is if the gross credit exceeds 10% of the qualified research expenses, then you only add back the amount that exceeds the 10%, not the full credit. Previously, in prior years, we would add back the entire gross credit amount to ensure no double dipping. So they revised that in relation to the amortization rules. So in this instance, our add back would be 40,000. So we would be reducing our 174 expenses to 960,000. That also revises our amortization to 96,000 in year one. So our revised taxable income, which is taking the 1.5 plus the 960,000 minus the 96,000, comes out to 2.364 million. If we look at the far right column, if you're just using the reduced credit and there's no add back to income, you're taking that 888 minus the reduced credit, which is getting you 777,000, which is giving you tax savings of 110,600, the same as the reduced credit. If we look at the column slightly to the left and we take the gross credit and with that add back to income, our final tax liability is now 734,680. So our tax savings are actually 153,320. And when I first ran this, I sat there and said, wait a minute, this can't be right. That's bigger than the credit. But when you factor in the revisions to the 174 expenses and the amortization amounts, that makes sense. So the gross credit, even if you are beyond that 10% amount, is going to give you a better situation than the net credit. If you are under the 10% of the qualified research expenses, then there is no add back, and you want to just take the gross credit because it's going to be 21% bigger than the net credit, the reduced credit. So this is a situation where the rules are actually helping taxpayers to offset some of this burden from the amortization. That being said, you're still having that increase from 174 in year one that really hurts. Year two stings quite a bit also. By year three, it isn't as bad. By year 4 or 5, you're breaking even and are ahead by 5 and 6. So this is something that you want to keep in mind when you're looking at your expenses. The longer you delay in implementing 174, the more it's going to hurt.
So for 2022, and this is important because I know a lot of people that are claiming the R&D tax credit, their consulting firm that they work with, they just go through the motions, fill out the form, section A, section B, 280C election, boom, we're done. There has to be some thought behind this now. It's not just 280C, boom, we're done. You have to take into consideration, should we do the gross credit or the net credit, and how that impacts above the 10%.
Yes.
A lot of this, I can tell you, most people will not understand. Even in our industry, I have no doubt that there are firms and there are individuals that will look at this and say, that's not our problem. We just send the information over to the CPA to figure out. The CPAs are now stuck with it. That's why we're encouraging groups, clients, prospective clients, businesses, CPAs, give us a call, reach out to us, because we want to make sure that this is done properly, and whatever advice and guidance we can give, that's really what we're here for. I had a question just come up, and I know we're getting close to that half hour. We may go over. Guys, are you still okay for another 10, 15 minutes?
Oh, yeah.
Okay, great. I just want to make sure. So a question came up about AMT. Now, I know, if I remember correctly, AMT is not an issue for businesses less than 50 million in average gross receipts for the prior 3 years or corporate. But for those businesses over 50 million, is there an impact play? Like, is there issues? What are some concerns and considerations we have to think about, or do we have to at all?
Well, there are multiple layers to AMT. And the one you mentioned about 50 million that's for the 25-25 rules to figure out credit usability in general. For historically, for let's just call them passive owners, the code section 56 preferences for the AMT required them to capitalize their 174 expenses. They get passed through on their K1 and amortize them over 10 years. And since they were generally expensing those for tax purposes on the 1065 or 1120S, that puts them in a position where they have an unfavorable adjustment, and AMTI is higher. That is, AMT taxable income was higher than regular taxable income. A lot of people got around that make this election under Code Section 59E2 to amortize their research costs over 10 years for all purposes, both regular and AMT tax. And so there would be no preference then, and there would be no disadvantageous adjustment. So what happened was TCJA got rid of the corporate AMT, and if you look at the legislative history for the act, it basically says, 59E2, well, AMT's gone. Like Congress forgot that people have pass-through entities. All right, at least the people writing the legislative history. So when we go back to the actual statute, the preference is still there. And 59E2 is still there, that election. So what do we do? And there are a couple of possibilities. One, it doesn't apply at all. And two, it does apply, but you'd be amortizing the amortization. And the service hasn't provided an official answer on it. If you read through the form instructions, though, for both the 4562 and the 6561, I believe it is, the AMT form, they sort of address this, and they very clearly say that the election and the preference in first place are for amounts that are fully deducted in the tax year. If you aren't fully deducting them, if you're following the new rules where you capitalize and amortize them in 2022 and beyond, then you don't fall subject to either of the rules. And that seems to be a logical result. So that type of AMT adjustment, it's out the window, it appears. We no longer have to worry about it.
Perfect. Perfect. And then what, I know we get this question a lot, lost positions. There's really no impact, I should say, on the amortization.
The amortization still needs to occur even if you have a loss position. And we have some companies that the income increase from the 174 amortization is actually causing them to no longer be in a loss position. It basically eats up all the loss and puts them into a positive tax position.
Okay, so I have a software company. I'm in a
Yep.
loss position. I have 2 years under my belt. If I have a huge, let's say in 2019 I started, 2020 I'm growing, 2021 I'm still growing, 2022 I get capital, I get investors, and I just have an explosion in my business and have huge expenses. I could actually, by doing that, end up in a tax owing position.
It's potentially yes. Now, if you have a bunch of losses to burn through, that's going to help you to offset the 174 add back to income.
Sure.
So losses are actually a good thing in relation to this change in the law.
Perfect. Okay. And then one last question. Again, guys, thank you for joining me today and for sharing this insight. And this came from a client of mine out in Montana, Wayne. He asked, what about self-employment income? Does that come into play? Is that considered an expense that I need to include?
Well, okay. So what he's referring to is including in the credit, in the research credit calculation for certain owner employees, say the owner of a sole proprietorship or partners in a partnership, they have income that is subject to self-employment tax, which counts for the credit. Well, 174 is very specific to costs. It'd be very difficult to see where, a partner's distributive share is treated as a cost of the partnership for 174 purposes. So it may be a situation, and this is yet again another area where Treasury needs to provide clear guidance, that it may count for the research credit, but it doesn't appear to count for 174 amortization, which would be a great result.
Yeah. All right. So we're still waiting on information on that. One last question. I promised you one last question before.
Actually, Michael, I want to make one point before your last question. And that's something that we've seen a lot of clients ask. They'll say, well, can I just not take the research credit and avoid 174?
That was going to be my next question.
That
was the last one.
The short answer is no. 174 is independent of the 41 credit. And whether you're taking the credit or not, you have to amortize your research and experimental expenditures. So just avoiding the credit does not mean you get to avoid 174. As a matter of fact, the research credit is the only main mechanism whereby you can reduce the impact of the 174 amortization. So it behooves you to take the credit in addition to amortizing the 174 expenses.
If you're eligible to take the credit.
Correct.
There are going to be some situations where taxpayers that are ineligible for the credit for whatever reason are subject to amortization. The most popular one being, we have a ton of software development, it's all offshore. Can't take the credit on that because it's not domestic, but it is subject to 15-year amortization as foreign research. And there are other ways to get around the impact. Not get around. Obviously, if you have huge NOLs to burn off, that helps.
Right.
If you are a pass-through entity and you have a QBI deduction, the increase in income from amortization could increase your QBI deduction. If you're sufficiently highly leveraged and subject to the business interest limitations of 163J, having the increase in taxable income could increase that limit, the 30% of tax EBIT limit. So you can actually deduct more in interest. And just depending on where you fall, as a taxpayer, there are options to ameliorate, if we want to use get fancy and use that term, the effects of 174.
So that question came up from one of our viewers. He used different expletives before saying, I'm just not going to claim the credit anymore. Based on what we're saying and what we've advised clients, is it's not really an option to just stop doing it, because you're catching yourself in a position that you probably don't want to be in.
No, 174 is a compliance issue now, and it is the law of the land. You are required to do this regardless of whether you're claiming the credit.
Yeah. Thank you, guys. I know that there's a lot more information. We're hoping to have another live event. In the interim, we at Source Advisors are hosting multiple webinars, CPEs, as well as webinars for end clients over the next couple of weeks. The next one is coming up on February 9th. That is in 2 days, on Thursday. Go to this link, Source Advisors, this link right here, try.Source Advisors. I'm not going to read the whole thing. Go there, just go to sourceadvisors.com and go to the webinars, register. For people that need CPE, we are offering CPE on the one coming up on the 9th. Sorry about that. And again, if you have more questions, concerns, thoughts, considerations about how do I do this? What do I do? Can you give me some insight or guidance? Reach out to us here at Source Advisors. That is what we want to be able to do, is help people go about this the right way the first time, so you don't have to backpedal. Jim, Brian, thank you guys. I really appreciate this. I know you guys added a lot of value in these 37 minutes, and there will be more to come. Hopefully, we will be canceling some of these events because it will be taken care of. But until it is taken care of, we're going to keep hosting these and giving information. Thank you, everyone, for joining. We appreciate it. Be well. Guys, thank you.
Have a great day. Bye.
Bye.